Hello, my name is Dave Zapponi. I'm the CEO of ECHO, otherwise known as the Executive Council of Homeowners. ECHO is a statewide nonprofit association created to support HOA board members and engaged homeowners. Our mission is to foster a better quality of life in community associations through education, advocacy, and connections. Thank you for participating today in this casual community conversation entitled Preparing the HOA for Taxes by William Erlinger of Levy, Erlinger and Company, LLP CPAs. We are happy to have you here. Please stay to the end of the program for a chance to win a copy of the definitive book on financial matters and HOA taxes in California, the Condo Green Book by the Levy, Erlinger Company. For today's event, we have a few housekeeping items. When hovering over the bottom of the screen, there are features icons available for use during this webinar. Please use the chat feature for any technical issues you may have during the program. Also, by using the chat, you can send a private direct message to any attendee. Simply go to the drop-down menu and select the recipient's name, then type your message and hit send. Questions for the speaker should be placed in the Q&A feature. Questions will be read during the presentation or during the scheduled Q&A session at the end of the presentation. Because the community conversation format is casual, Bill has agreed to take questions sporadically during the program. Due to the number of participants, we may not be able to answer all your questions. We will answer as many as possible in the time allotted. Note that some responses will be typed into the Q&A feature during the program, either by Connor, me, or the speaker. This program is being recorded. A copy of the recording, along with the presentation slides, will be emailed to registered participants within 7 days of the program. This event is copyrighted by ECHO. We do not give permission to others to record the meeting in whole or in part. Please always be courteous and respectful of the webinar participants, including the speakers and the sponsors. Except for sponsors, this program is not a marketing forum for professional service providers. Any participant may be removed at any time at the discretion of ECHO for any reason and at any time. Participants are solely responsible for their comments. Finally, our disclaimer. None of what is said during this seminar shall be construed as specific legal advice from either the speakers, sponsors, or ECHO. If you would like specific advice, we encourage you to contact your attorney. Now on with the program. Our webinar today is Preparing the HOA for Taxes, presented by William Erlinger of Levy, Erlinger and Company, LLP CPAs. Bill received his BS in accounting from the University of California, Berkeley, his MBA in finance from Boston University, and his MS tax from California State University, Hayward. His MS tax thesis was on taxation of homeowner associations. He is a member of the California CPA Society's Planning Committee for Common Interest Realty Associations and is a frequent speaker at their annual conference. Bill is also an active member of ECHO, including being former chair of the CPA Resource Panel and a contributor to the ECHO Journal. He has been instrumental in working with the California Franchise Tax Board to be more responsive to policies affecting California homeowner associations. These include the online publishing of exempt organizations and exemption application requirements. Thank you, Bill, for conducting this seminar for today. Let's start the program. Bill?
Thanks, Dave. And good afternoon to all of you. It's such a great audience. Many have said that the subject, accounting and taxes, on the, I would just call it politely, on the dull side. While that might not be my opinion, I can tell you, whenever my wife has trouble falling asleep, she'll say to me, "Dear, tell me more about your work." And it seems to work like a charm. Anyway, so Now the slides are going to get advanced when I say next. So I think if we're ready to roll, next. Okay. And wasn't there a polling question to come up?
Yes, there it is.
Ah,
There's a
good,
polling question.
good. So what is your status? Treasurer, board member, homeowner, service provider, none of the above, or you don't know? And the second one, it's a trick question. Do you think your homeowner associations need to pay income tax? And there's no harm in saying you don't know, because that's okay. Great. Great.
Give them a
So,
couple more seconds to answer the questions.
of course. Yeah.
Okay. So for the first one, the what is your status question, we had 11 people that are treasurers. 9 of them are board members. We have 5 homeowners, 1 service provider, and 1 who's none of the above. And then for do you need to pay taxes for your HOA? We had 17 people say yes, 3 say no, and 7 were not sure.
Great. I appreciate the results. It's very useful. So great. Moving on. This presentation is structured to go from the general to the pretty specific. So if you've got your specific questions, maybe it'll be addressed later on. But starting out, we'll just talk briefly about what's the tax administration for homeowner associations. It's the same for individuals and all others as well. And at the federal level, you might seem pretty basic. That's the Internal Revenue Service. And the service center that's really the hub for homeowner associations in the San Francisco Bay Area is the Ogden Service Center. Now, the state tax administration is by the Franchise Tax Board, and while they're located, their home base is Sacramento. The area that's of most interest for homeowner associations is Rancho Cordova, which I believe is pretty close. Now, I sort of appreciate the history of taxation, although that may be something you're not interested in at all, but it gives you a sense of all the tax law when you're looking at things. And the tax law goes back for corporations. Why I say corporations, because corporations are what homeowner associations are, whether they're legally one or not. But corporate tax law goes back to the early 1900s, quite a ways ago. Now, the other point of note is the Internal Revenue Service Revenue Ruling 70-604, which you may or may not be familiar with. We'll go over a little bit later in the presentation. And this comes from, you could guess, 1970. Maybe you can't, but it comes from 1970. So that's quite a while ago. Now, in 1976, Internal Revenue Code Section 528, which is titled Homeowner Associations, was enacted. Now, there were homeowner associations before 1976. So why was it in 1976 all of a sudden there's this legislation? Well, best I could tell is that there were homeowner associations just starting out. They're just growing in numbers. And Congress was sympathetic to these, they were at the time small associations that they were run by the owners there. And they believed that the owners didn't really understand or want to know about corporate tax. So they needed a way to make it easy for them to prepare and file tax returns. So they came up with Form 1120H, and there's rules that go along with it. So while the intent was well-meaning, it's pretty confusing still, but that's the reason that there is such a thing as this Section 528. Now, moving forward to 2018, that's about the most recent change in corporate tax. And that's when the corporate tax rates were flattened out to currently 21%. But if your tea leaves can look in the future, it looks like that's probably going to change. And California in about 1978 enacted the exemption for homeowners associations. We'll talk a little bit about more later on. Okay, next slide. Now, I'm going to try and address what I call myths and misconceptions, because you cannot believe how many times you get these, at least I get these kinds of questions, and it's just endemic into the HOA industry. The first one was that associations are not, and I said sometimes, required to file income tax returns. And 11% of you said no, and 26% of you are not sure. Well, let me shed light onto this. Federal law requires homeowner associations, because they are a corporation for tax purposes, requires them to file a tax return. And for your edification, I gave you the Internal Revenue Code section and the regulations section that says that tax returns must be filed. We'll talk about penalties a little later. So that out of the way, talk about California. California also requires corporations to file tax returns. And again, I cite the Revenue Taxation Code section that says why or what's supposed to do, why are corporations required to file a tax return. Now, the Franchise Tax Board Exempt Unit and I have had discussions many a time, and we have, too strong to say, differences of opinion, but they'll say that once a homeowner association gets exemption from franchise tax, which we'll talk about later, is that they do not have to file an income tax return unless taxable income is more than $100. So it could be a gotcha. You can say, oh, look, we don't have to file a tax return because our taxable income is under $100. Well, there's an expression called the Pyrrhic victory, which means that maybe you were correct here, but you'll be sorry later on. And I'll tell you what the sorry is that the Franchise Tax Board in a year or two is going to send a notice out to the last address of record saying, how come you didn't file a tax return? So you have to answer them, or you have to send a tax return. But if you don't answer them, then they're going to presume that you're guilty, you should have filed a tax return, and they're going to take punitive measures against the association because you didn't respond. So the best thing to do, and the simplest thing to do, even though we may technically be wrong, is to file a tax return with the Franchise Tax Board every year, regardless of your taxable income. Okay. Next myth and misconception. And I told you how many times I get this question. Most everyone in the associations looked at their, believe it or not, their articles of incorporation. And probably the first sentence says that we, the association, are incorporated in California under the California Nonprofit Mutual Benefit Corporation, and so on and so on. Well, I'm not an attorney, but I could say that when any reader sees that nonprofit in that first sentence, they automatically, and it's human nature, they think, whoa, we don't have to pay tax. We're a nonprofit. Well, let me tell you that the articles of incorporation have legal meaning in civil law, but when it comes to tax law, they're meaningless. Neither the IRS nor Franchise Tax Board give a darn, particularly what the articles of incorporation say. If you want tax exemption, you're going to have to apply with both of them to get it. You can't just get it because your articles say you're nonprofit. So to get exemption from taxes is an involved procedure. It's pretty expensive. And if you're a homeowner association, you're not going to get it. So when I say, you're just not going to qualify to get exemption from income tax. So now they mentioned about corporations. Some homeowner associations are unincorporated for numbers of reasons, because that's how, whatever the reason was. Now, while unincorporated, they still must treat themselves for tax purposes as though they're a corporation. So they file the same tax returns as an incorporated homeowner association, except they do not have to file for exemption from franchise tax, because franchise tax only applies to an entity that has gotten a corporate lot as a corporation. legally a corporation. So if you're unincorporated, you don't need to apply for exemption because you're already exempt. All right. And the last myth and misconception is the other one, where there's always an argument that someone will know that there's a form 1120H, and on it says income taxation of homeowners associations. And they conclude, and I would disagree necessarily, that this is what form we have to use because we're a homeowner association. Well, that's wrong. Sad to say, wrong. Before 1976, there were plenty of homeowners associations, and there was no form 1120H at that time. So just because the form says it's for homeowner associations, that doesn't mean that you have to use it. It's optional, for one. And secondly, is that you need to be a qualifying homeowner association before you can even consider using form 1120H. And as we get further into the presentation, you might get my opinion. My opinion is that 1120H is a much more expensive proposition than the form 1120, much more expensive. And I'll get into all that. So, all right, that takes care of all the myths, the misconceptions, and so forth. All right, and now into the tax administration and accounting. So we have time for, it was kind of a useful, interesting kind of a joke, and it's and when you hear about it, you want to catch on. And if you're a manager, my apologies, but there's a hot air balloonist out in the Napa Valley, and the person got so confused and disoriented, didn't know where they were going. So they lowered themselves, got close to the ground, and they see someone walking along a road. And they yell out, hey, can you help me? Help me. And the person doesn't look up. So they get lower and lower and lower. Finally, they get up close enough, they're yelling to the person walking. They say, hey, can you help me? Can you help me? Can you tell me where am I? Well, the person walking along happens to be an accountant. So the accountant looks up to the balloonist and says, well, I'll tell you, you're in a hot air balloon about 30 feet above the ground. And the balloonist says, well, thanks a lot. Thanks a lot, guy. You're technically correct, but that's of no use to me. Well, the accountant says to the balloonist, you must be a manager. And the balloonist is puzzled, says, why, yes, I am. How did you know that? And the accountant says, well, you don't know where you are. You don't know where you're going, but you expect my immediate help. And you're in the same position you were before we met, except now it's my fault. All right, well, I think that's a good introduction into the next section of tax administration and accounting. So there's different tax rates for the different tax forms. Currently, Form 1120, which is the tax form for corporations, it's 21% of taxable income. Form 1120H, which I spoke about briefly earlier, for homeowner associations is 30% of taxable income. The taxable income on Form 1120H is not the same as taxable income on Form 1120. And lastly, Form 100, which is the California tax return, the tax is 8.84% of taxable income. So in other words, the combined tax rate on Form 1120 is 28%, and the combined tax rate on Form 1120H is 36%. Being accountants, or most of you have accounting bent, you can say, hey, that doesn't add up. 8.84% and 21% are 29.84%. Well, the reason that there's a difference is that the state tax is deductible on the federal tax return against taxable income. So you just can't add the tax rates together. Okay. All right, next slide. Tax returns have got due dates. Now, let's just presume, make it simple, that the due date, well, the tax the association's year end is December 31st. So the due date of the return, whether it's Form 1120 or 1128 or 100, is the 15th day of the 4th month after the end of the year. You say that's kind of odd way of speaking, of meaning April 15th, but it's while it's awkwardly structured, you come out with the better result. So the 15th day of the 4th month takes you to April 15th if the year end is December 31st. Now you can prepare and file an extension, and the extension needs to be filed on or before the due date, otherwise it's ineffective. And an extension is for 6 additional months. So a return that's due April 15th, once an extension is filed, it's now October 15th. I need to point out, though, that, and this is another misconception in a way, that extensions are only of time to file. There is no such thing as an extension of time to pay. It's only to file. You say, what's the difference? Is that if you get an extension of time to file, you don't get hit with the late filing penalties, which are a lot higher than late paying penalties, which will get penalties a little bit.
Bill, can I ask
Yeah,
a real quick question? Connor, can you go back one slide to the 1104? Okay, so if you're an HOA, homeowner or board member, are you recommending then that they fill out 1120, 1120H and 100 and then see how things fall out, or is that how you would make a determination? How do you determine which form to use?
Well, personally, I wouldn't use 1120H, period. The tax is almost always more, for one. Secondly, is the tax, we'll get it later, the tax base, which is described on 1120H, is much broader than Form 1120. And lastly, nowadays, it's a big deal. Form 1120 can be e-filed. Form 1120H must be paper filed. So all that points to an 1120 form to use. Of course, if you're doing it yourself, then you'll not be able to e-file the return, and you'll have to paper file it. So then that option's there to use Form 1120H. But a recommendation usually is to have an outside party, CPA or an accountant, prepare the association's tax return. That answers the question.
Yeah, so the 1120 and 1128, you're saying that in most cases it'd be 1120 that you're recommending. And
exactly, that's right.
So the Form 100 is a California.
That's correct. That's right.
All right, so that's helpful. Thank you.
Okay. So going forward, we got to the due dates, which was the next one. Yeah, before I go to the next slide, to bring up, it's a minor housekeeping matter, but it's worth its weight. Whenever your association's mailing address changes, it could change for any number of reasons. But when it changes, when you move your personal address, you always tell the post office and you tell others about your change of address. Well, think the same way with your homeowner association. If the mailing address changes, you should notify the IRS and the Franchise Tax Board that there's a new address. Because if a notice gets sent to the old address, it may never make it to where you can do something about it. And you can get the association into no end of trouble just over something as simple as that. And both IRS and Franchise Tax Board have their own forms for notifying one another of a change in address. So it's a good thing to know. You can pull off the form off the internet. So if there's a change in mailing address, let the IRS and Franchise Tax Board know about it. Save you no end of pain later on. Okay,
hey, Bill, here's a couple questions that came up in the Q&A section.
Yeah.
Carolyn Estrada wants to know if the Form 1120 costs more, and then John made a comment as well. If you want to take those two.
Oh, we don't. Our fee's the same. It doesn't matter 1120 or 1120H. Not at all. I mean, it's true. Form 1120 is 1120H is 1 page. 1120H is at least 5 pages, but our fee is not based by page. but I can't speak for other practitioners. So the our
But
fee
if they're-
doesn't change.
But Bill, if they're
Yeah.
self-managed, we have a lot of self-managed, probably a third of our membership self-managed.
Yeah.
And they wanted to fill out their own form, maybe it's three separate units or 15 separate units. Are you still recommending they go to a CPA or to a bookkeeper to do this?
Well, you know, it's always a question. Yeah, if they have $10 of interest income, then you might as well, yeah, you could do this 1128 yourself. But there's many times that there might be other issues. You have other kinds of income. In there was an association. This is a war story. It's south of Market, and they were doing their own tax return, and they decided for whatever reason that they wanted to have us do their tax returns, and we're talking and just talking with the board president. I said, well, what's your income? What's your income? She says, oh, you know, we've got, I think they have 8 units. Oh, it's from assessments, and we have some late charges. And I said, do you have any other income? They, oh, yes, little interest income. And just, yeah, you know, we have a billboard. Yeah, they have a billboard on the side of their building that currently they get $50,000 a year from.
Wow.
And this $50,000 a year, then they proceed to tell me that they've never filed tax returns before. I hate to say, how far back does the $50,000 a year ago? She says, oh no, it's only been a couple of years, and before that it was only $5,000 a year. And well, when, as I mentioned earlier, well, actually, no, I haven't mentioned, we'll get to it, the statute of limitations. So, needless to say, you never know. I think it's just a good idea. If the only source of revenue for your association is assessments, and you have nominal amount of interest income, you can do the tax return yourself, Form 1120H. And as I said, if you have exemption and your interest income is under $100, you don't have to file with the franchise tax board either. But you know, there's risks involved there, but that's a decision you have to make yourself.
Yeah, and you don't need a CPA to file your tax return.
No, not at all.
You can do it yourself.
Yeah,
Okay.
yeah. The only thing is you cannot. Well, California requires e-filing of the returns, but you know, I don't think they're not gonna give you any trouble if you just mail them in.
Okay, well, there was one other, I think, finer point on the 1120H, and you see John Rickard's question there. He asks, it's presumed the application of the IRS 7604 rollover and allows an HOA to bypass the need to have that election. Is that, and that's potential savings. Yeah, I don't have a clue what that means, but.
Oh, I see. We're going to talk about that. That's true. You don't have to have, if you're going to file Form 1120H, you don't need to have a 7604 election. But as I'll say, you're going to pay a lot. Not only is the tax rate higher, but the tax base, meaning that what's subject to income tax is a lot greater. So there's not much of a cost to do the 7604 election. But we're going to talk about that in a few minutes. Hope that answers it.
Okay, that sounds good. One more, and then we'll move on with the program.
Yes.
Just to clarify, Helen asks, filing deadlines are based on fiscal year end versus calendar year end. Is that
correct?
Okay.
15th day of the 4th month.
15th day of the 4th month. Okay.
Yep.
And are the form filing deadlines the same for all federal and California state tax forms?
Form 1120, Form 1120H, and Form 100 are all the 15th day of the 4th month.
And she also mentions California Form
199. The 199. Oh, all right. We got someone who's a little more. How would I say? All right. It was a little more. Yes, it's that 15th day of the 5th month. You are right about that. That's true. But from a simplicity standpoint, the earlier date applies to the ones you worry about. So if the 199 is filed earlier, no harm, no foul.
Great.
But you're right, it's the 15th day of the 5th month. Great.
Thank you.
Okay. Moving on to the next slide. This is the this is ulcer page. This is the part where everyone's got to cringe, and it has to do with penalties. Now, the taxing authorities are only going to levy penalties if something is late filed and it owes tax, or you didn't pay on time. So it's a pretty narrow window of things. Now, there's the three kinds of penalties. There's the estimated tax penalty, there's the late filing penalty, and the late paying penalty. Start off estimated taxes. Now, the tax authorities want their money as you go along. Make the similar to if you're an employee and you have a salary, you know that taxes are taken out of your salary each paycheck. And if you're self-employed, you know that you have to make estimated tax payments 4 times a year. Same applies to your homeowner association. You need to make estimated tax payments. Now, what is the safe estimated tax payment amount? It's 100% of the prior year tax. So that's a really good safe estimate. So if your tax last year was $100 for the federal return, if you pay estimated taxes of $100 or more in the current year, you will not be penalized. Is there anybody? I haven't seen anybody say anything yet. All right, anyway, let's just say though, if the tax last year was 0, so you think that estimated tax payments for the current year should be 0? I'm afraid the tax authorities don't agree. 0 doesn't apply. If tax in the year before was 0, then the only safe estimate payment is 100% of the current year tax. So that's always a dilemma in a year that you didn't have any tax, that you don't really know what your safe estimate's going to be. All right. Now, late filing penalties, that's why you file an extension. You can see the late filing penalty is 4.5%, while the late paying penalty is 0.5%. 4.5% per month on the balance showing on a return. So if you don't show any balance due on the return, there's no late filing penalty. And likewise, look, there's no late paying penalty. So you may file a return late, but if you paid everything up by the due date of the return, then there are no penalties. Surprise, but there are none. The IRS has the ability, if they choose, to levy a minimum penalty of $65 if your return's late, but I've never seen them do that. Anyway, just have to mention it. Now, in the scheme of things, the tax authority, you should be more, I would say, concerned, but has much more teeth than the other, and that's the Franchise Tax Board. The Franchise Tax Board is the pit bull here, and in addition to the powers they have, like the IRS, which is to levy monetary penalties, they also have something in their arsenal which really gets everybody's attention, and that is they can suspend the corporate status, they can revoke the corporate status, and they can revoke the exemption that the association has from the franchise tax. And there is no de minimis amount. You could be delinquent with the Franchise Tax Board for $10, and they'll yank the corporate status. And you won't know about it until one of the owners happens to be surfing the internet and looks at the Secretary of State's website and finds out that the corporate status is suspended or revoked. And I'm not giving out legal advice or opinion, but a suspended corporate status means your association cannot legally conduct business and cannot enter into contracts. That's a big deal. And also, it means that I believe the boards of directors no longer have immunity from a lawsuit filed against the association that they would have if the corporate status were in good standing. So it really gets everybody's attention a whole lot more than a penalty of 0.5% a month on a balance due. So that's the landscape of the penalty arena. Moving next, thank you. But as I mentioned earlier, the tax returns for the Franchise Tax Board, the Form 100 and the Form 199, must be e-filed. Now, how does that fit in with a 2-unit association that does their own tax returns? I can't imagine if there's a, if they send you a penalty notice, I think you could easily tell them that we prepare the returns ourselves. We don't use a paid preparer, and we have no access to e-filing, and they'll abate penalties. I can't imagine them levying a penalty like that, but you have to mention it. Now, Form 1120, the federal corporate tax return can be e-filed. It's not required to be e-filed, but it can be. Now, Form 1120H cannot be e-filed. I have no idea why. And I have no idea whether IRS is going to, in the future, permit e-filing Form 1120H, but the present time can't be done. Now, mentioned earlier about the statute, speaking of filing, is the statute of limitations. Now, that's an expression meaning legally, how far back can the tax authorities go to a year and examine it to see whether tax was paid correctly or not. The Franchise Tax Board is 4 years. With the IRS, it's 3 years, meaning that, let's say your 2020 tax return is filed April 15th, 2021. The IRS can go, you're not theoretically in the clear until 22, 23, till after April 15th, 2024, and April 15th, 2025 with the Franchise Tax Board, until neither one of them can go back and examine that year. You mentioned, you recall, I spoke earlier about those associations, or you don't file a tax return. So if you don't file a tax return, what do you think the statute of limitations is? I'll answer for you. There is none. If you don't file, the tax authorities can go back to that year, no matter if it was 50 years ago. Can't imagine anyone wanting to do that, but they can go back and open up that year to see if tax is paid correctly or not. That's another reason to file a return every darn year, because it keeps the statute running. Not running, but it tolls that statute so that the tax authorities are limited if they ever want to go back and examine a prior year's return. You think?
So Bill,
Yeah.
why don't we can we take a little break here and answer a couple of these questions?
Yeah, sure.
Okay. So Leaf is asking, our CPA files a federal tax return on Form 990.
Oh my goodness.
Tax exempt from the federal, but California,
Yeah.
Form 100 and for California, is there a difference on the filing of schedule dates?
Oh, you're correct. Yeah, the 990 is like the Form 199, 15th day of the 5th month. And the penalties there, Dave, you can commiserate. The penalties for failing to file a Form 990 are tremendous. They're unbelievable. And so a 990 is not getting an extension, not filing on time can be very, very painful. And you can get the penalties abated, but it's very, very painful to see.
Is the filing date different? Is there a difference on the filing schedule date?
Yeah, the 990 is the 15th day of the 5th month.
Okay, and the Form 100?
And the Form 100 is the 15th day of the 4th month.
Huh, okay.
It's pretty unusual for a homeowner, for an association to have a 990 federal and a 100 state. In fact, sounds like a client. I don't know if it's a client or not, but there are not many of you like that. Usually, if you get exemption in one, you get exemption with the other. A Form 990 is for a homeowner association that has exemption from tax. And there are some. Usually, those are very old associations.
Okay, well, Amber asked another question here. She says, when you pay estimated IRS taxes using the EFTPS,
right?
Yeah.
Electronic taxpayer
service, I guess. What year should you enter for the HOAs with fiscal years? The beginning.
That's a great question, Amber. That's a great question. I can't tell you how many associations would have fiscal year ends, meaning year ends other than December, get this wrong. And it's nobody's real fault. It's just because the whole process is so, well, because we're recorded, I won't say the word. It's so awkward. And that's because let's take a December year-end association. The year-end begins January 1st, it ends December 31st. So if the year ends December 31st, 2020, the tax form is the 2020 tax return. It's not because the year ended 2020, it's because the year began in 2020. Now you can see where this is headed. So if the fiscal year, it's a June 30th year end, the year end begins July 1st. So associations July 1st, 2020 to June 30th, 2021 would be the 2020 Form 1120. But when you're making estimated tax payments, you apply them to the year ending. So if your year end is December 31st, well, the year beginning, the year ending are one and the same. You don't have to worry. You'll apply the payments correctly. But if your year end is June 30th, do not apply the tax payment to the 2020 tax return. The IRS is going to apply it to last year's return, see you don't owe any tax, and they'll refund the money and you'll deposit it and you won't have any estimated tax payments when you file the return for June 30th, 2021. This goes on frequently. Tax payments are applied to the year ending, not the year end, not the tax return year end. No, it's the year ending. Sorry if I made that more confusing, but it's the year ending.
Okay, that sounds good. John Rickard asked another question here.
Yeah.
The 1120H can't be e-filed because that person hasn't retired from the IRS yet. Okay. Doesn't know how to read a PDF. Okay, that was a statement, but we like it.
Yeah. Okay.
Okay.
Yeah, as soon as the guy retires, then no one else is going to want to process those 1120Hs. I don't blame them. So they'll want it electronically.
Okay, so Carrie Davenport, and this is the last one for this section. Carrie, our CPA files at 1120H when we have an excess of revenue over expense at fiscal year end. They file the 1120 when we have a deficiency of revenue over expenses. We always vote every year on the 70-604 BC.
Very good.
We have yearly elections, and it passes every year, giving our CPA the choice when they prepare our taxes. You stated you should always file an 1120 versus an 1128.
Yes.
DT, I'm not sure what that means.
By the way, BT, what that mean? Anyway.
The high rate of taxes for the 1120H at 30%. Why would our CPAs file an 1120H knowing it's such a higher tax rate?
I couldn't answer that. My opinion is that there is no reason. One is, the tax rate's higher. And secondly, the tax base is broader, which I'll talk about in a little bit. But I can't see any reason for doing it the way that they're doing it. If they can do the 1120 when you have a loss, why can't they do it when you've got a gain? And you'd say you make the election every year. Sounds great to me.
Yeah. Okay. Let's go ahead and move on, and we'll come back to Donna later.
Great. All right. Tax payments. Tax payments must be made electronically with the IRS. Now, is someone going to get in trouble if they mail you think they're not going to cash the check if you mail it to them? No, they'll cash the check. They may not apply it correctly, and they don't like it that way. They have the ability to penalize you for doing it, but they'll take your money if you mail it to them. You're supposed to do it electronically. Now, the Franchise Tax Board is a little more easier to work with here. The Franchise Tax Board will let you pay by check, or you can pay online. And it's so simple to pay the Franchise Tax Board online. You just go to the section called Web Pay for Business, and you tell them you're not a robot. You give them the corporate ID number. You tell them what form and the amount. It's easy. While with the IRS, you're going to have to enroll in EFTPS, and you get a PIN number. And then it's not so simple. So what can I say? You can still write the check to the IRS, make the check payable to the Department of the Treasury, put the form number and the year on there and the tax ID number when you send it to them, and I would include a transmittal letter. All right. And we already talked about the fiscal years. That's a really hot topic. Okay. That takes care of administration and accounting. So it's a good time for a poll question.
Connor?
Who prepares your tax return? Accountant, CPA, bookkeeper, you do it yourself, or none of the above?
Bill, you might take a look at Donna's question there.
I don't know how to find it.
At the bottom, if you click the Q&A section.
Oh, okay. All right. Oh,
About
I'm
10
I'm
more
gonna
seconds
address
on
that
this poll.
question. I'm gonna address it.
Okay, well, that's pretty unanimous on this one. 25 of our participants today, they file it via CPA or an accountant, and only 2 they use a bookkeeper.
Right.
No one files it themselves, or at least didn't want to say they filed it themselves.
Yeah, that's pretty
Huh.
interesting.
Okay. Great. Okay. So now we're going to get into the meat and potatoes section. So hold on to your chair. We talked about that revenue ruling 70-604. It comes from 1970, so 51 years ago. And my material here says sample wordings at the end of the material. My bad. If you give me or give Dave or Connor contact information, I can send you. It's short. It's a 1 page, and it's the sample wording you can use so that the members can enact or approve the 7604 election. Now, the IRS very, very generously has given homeowner associations a way to make membership income not be taxable. Of course, that means the membership expenses aren't deductible, but it doesn't matter. So the members must make this election. No one else can make it. It can't be put into your governing documents. The board can't do it. It must be the members. So at a member meeting, it doesn't have to be an annual meeting, because that's always a member meeting, but at a member meeting, I would think you need to make it pretty clear that it's a member meeting, that this election must be made, and it doesn't have to be by secret ballot. It doesn't have to be by open ballot. It can be by voice vote, or it could be by raise of hands. There's nothing in the rev ruling that says it has to be one way or another. And there's nothing in the revenue ruling that says the meeting must be legal. It must be, according to the governing documents, a legal member meeting. It just says a member meeting. So I would take it at the most permissive side to say that it's a member meeting. Whether or not you could conduct legal business, that's one thing. But we're talking about a tax election, and I believe that the members present at that meeting, a noted member meeting, can make the election. Say by ballot, it could be by raise of hands or by voice vote. All in favor, aye, and then you move on. This has absolutely nothing at all to do with the physical transfer of money from one bank account to another, operating to reserves, reserves to operating. It has nothing to do with that whatsoever. The board at any time can make a finding that they have surplus money in the operating bank account, and it's in the best interest of the association to move that surplus operating money to the reserves. And they make a finding in a meeting, and they approve it, and it's done. It has nothing at all to do with this revenue ruling 7604 election. Let me repeat, the election has nothing to do directly with reserves. It has nothing at all to do with transferring or writing a check from one bank account into another. Of course, this is only applicable to Form 1120. Form 1120H, it's not applicable. Okay. All right. So moving next is on Form 1120, what exactly is taxable income? Well, in the Form 1120 land like to use the word non-membership rather than taxable. What is non-membership income? Just as it's net non-membership income. That's membership income after allowable deductions. Non-membership income, excuse me, is something where the source of money is from non-members. The usual suspect are bank interest. You always get bank interest, and the bank's not a member of the association, so that's non-membership income. Some of the other examples are you have Comcast income, you have a cell tower on your roof, you have a billboard that pays you $50,000 a year, you have an oil well, you've got non-member income. That is taxable unless any allowable deductions. Now, the allowable deductions are pretty limited. That must be beyond the scope of this presentation. Okay. Then next slide. Form 1120H. As mentioned earlier, the 7604 election is not applicable if you're going to use Form 1120H. Now, Form 1120H, instead of using, as I said, non-member income on Form 1120, they like to refer to non-member income as non-exempt function income. Now, they're not exactly the same. They have similarities, but there are also some great differences. Let me point out the differences. And this is the reason I would suggest that you think closely before doing the Form 1120H, because income that's not taxable on 1120 is taxable on the 1120H. Example one is laundry income. Laundry income comes from members. So it's not non-membership income. It's not taxable in Form 1120. But on Form 1120H, that is non-exempt function income. So it's taxable. Same goes with late charges. On Form 1120, it's from members. 1120H, that's not non-exempt function. It's non-exempt function, excuse me. Fees to use the facilities. In other words, if you have to pay to play golf or you pay to use the tennis court, taxable on 1120H. Gain on the sale of an association-owned unit. That could be a very, very big deal on Form 1120 versus Form 1120H. On Form 1120, it's membership. On Form 1120H, it's taxable, non-exempt function income. Okay. Moving on, next slide. California Form 100.
Well, hold on, Bill, just a second, Bill.
Yeah.
We're backing up on questions here a little bit.
Yeah, sure, I imagine, yeah.
And some of the stuff that we just went through. So let's talk, Robert has a good question here. Maybe you can pull up your little Q&A. Why does it take so long to get the California Franchise Tax Board to grant the exemption? And
good question.
Yeah, speed up that process.
You can't. Well, the reason is they're understaffed. That's the simple answer. They're understaffed, and they, how to speed it up? Have your association sued or sue somebody. I'm not making a joke, but if your association is in litigation, you go to the front of the line. And instead of having to wait 3 to 4 months before they'll work on it, they work on it right away. There are there's other examples, but that's the main one. If you're in litigation, definitely go to the front of the line. Otherwise, it's true. It takes a long time. And when they ask questions, if you don't give it to them right away, you just postpone the inevitable, when they'll end up denying the application because you didn't respond. But yeah, the main answer is they're understaffed.
Okay, here's a question about the governing. It says here from an anonymous attendee, our governing documents say that the fiscal year is January to December,
yes.
But for whatever reason, the board uses October to September. What kind of mess does that put us in?
That sounds like a legal question. I would refer to legal counsel.
That's probably.
And I would believe that they're going to tell you it needs to be an October year end. I'm not sorry, it needs to be December year end. If your governing documents say that, but that's a question for counsel.
Okay, here's another one from Helen Lee. I've heard of cell tower income. What is Comcast income?
Comcast is when they pay the association a fee. It's usually per door, $75 a door, $100, $50 for the right to market to the owners, the right to have access to the common area for putting in cable and other anything to do with providing services to the association.
Okay, and here's one from John Rickard.
Yeah.
What if during the 7604 election, a majority of votes to distribute the majority votes to distribute the surplus back to the members? Potential tax liability drops to zero, but so does your surplus. Any comment on that? Have you had that happen? I haven't had to.
Out of the thousands and the thousands of returns, I've seen it, I believe, at least once, maybe twice. And not to be disingenuous, when you see the election that will send you, you're not giving the members an option. You're not saying, well, either you can apply the surplus or excess assessments to next year's budget, if there is any, or we'll refund it to you. You don't just say refund it. The members will say, if we have excess assessments, apply them to the following year's budget. That's all. If you say, well, it's to be refunded, then you're making it much more difficult for everyone. And if you do say refund, you say, well, if you're going to do it, we're going to have to charge an administration fee of $10 per unit to cut the checks, to put them in envelopes, to address the envelope, put postage on it, to track the check. So while you may only get $6.45, it's going to cost you $10 for us to do it. So, how much money can really anybody get back? Anyway, I don't know if I really answered the question, if I kind of went sidetracked.
Here's a little bit of a related question.
Yeah.
David O'Connor asks, we are a mutual benefit nonprofit co-op. Our property taxes and mortgage interest are written off on our corporate taxes, I believe, or he believes. Would this deduction be better served to be passed on to the residents?
Well, the mortgage, I believe section 214, 213 is for the pass through of property tax and mortgage interest to the owners. So that's something the co-op should be doing for you. Excuse me.
Mm-hmm. Okay, thank you for that. Leaf, we'll get back to you on that. That's a long question you asked there, so we'll get back to you. Let's go ahead and keep going with the program.
All right, thank you. Okay, now talk about, next slide. The reason I'm even bringing this up is because this has to do with who's going to be paying, which fund is going to be paying the taxes, operating or reserves. Well, the reason to bring it up is because if it's an operating expense, it needs to be in your budget. But if it's a reserve expense, like other reserve expenses, it's not part of your budget. So which one's the right answer? I can tell you that reserve study preparers will do it either way. Some of them show interest income and they show interest, and so taxes on that interest in the reserve study. Some of them they'll say interest net of tax on the reserve study, and others will show pre-tax interest in the reserve study, suggesting that, well, the tax is paid out of the operating fund. So there's all different ways that it's been done, and each reserve study company seems to have their preference. Now, as outside CPAs, we're going to take the tax and allocate it to the fund where the taxable income arose. So if the bank interest is earned in reserves, we're going to allocate the expense for the tax to reserves. Now, we would do that because GAAP would say that's what we should do. However, tax is immaterial to the financial statements. So if it was a board decision to pay the tax out of operating, then we would go along with it and we would show it as the board wanted it. But as I mentioned, there's nothing illegal or wrong with not having a budget for income taxes, because the taxable income is reserves, mostly it's reserve interest, and that the tax ought to come out of reserves. So maybe some of you can now claim that money that you previously budgeted for income taxes to offset some other kind of operating expense. Okay. All right. This is not a trick question. Does your homeowner association have solar panels? Wow. Okay. Looks like
10 more seconds.
maybe we'll ask the question again after I'm done.
Okay, so for this poll, we had 7 people said yes, they do have solar panels. 14 said no. And then we have 2 people that were their HOA is
Thinking
thinking
about
about adding.
Very good. Well, I think you think about getting them while they're still available. Get it while you can, because it's going to go away after the end of 2023. It's gone unless Congress extends it. But a tax credit is a dollar for dollar reduction in association or reduction in tax. We'll talk about whose tax, but it's a dollar for dollar reduction in tax. So it's better than a deduction. It's a dollar for dollar tax reduction. Okay. Now the solar energy tax credit right now through December 31st, 2020, the credit is 26% of qualifying expenditures. So if the qualifying expenditures are $100,000, we're talking $26,000. That's a lot of tax. In 2023, the drop is from 26 to 22%. After 2023, it's gone. Let me remind you though, but before 2021 and 2020, it was 30%. So you see that the credit may just go away. And I'll show you to describe how the tax credit's computed. It's qualifying solar energy expenditures times the qualifying percentage. Currently 26%, soon to be 22%, and after 2023, 0. So you're talking, that's a pretty generous tax credit. It's non-refundable, but we'll talk about that in a minute. So the question, the constant question is, well, gosh, who gets this tax credit? Let me tell you, your association neither can nor wants to get the tax credit. It's not going to the expenditures won't be qualifying expenditures if the association spends its money to pay for solar panels or some other solar energy equipment. So what exactly is it supposed to do? Well, first of all, it's an operating expenditure, not replacement. So if the association wants to take or special assesses the members, let's just say make it easier that there are 10 members and it's $100,000 expenditure. So the association spends the $100,000 to put solar panels on the roof, say. Well, we're talking $26,000 of a tax credit. Well, the association doesn't qualify for it. But what the association does is recommend by January, say the 15th of the year after the solar energy expenditure, you notify the 10 owners of what their share of the qualifying expenditures were, making it simpler that if each owner pays the same assessment. So $100,000, the qualifying expenditure for each owner would be $10,000. The association notifies the owners that they have a qualifying expenditure of $10,000. And each owner on their personal tax return puts it on I didn't put it here, you have to look at the right form. And you're going to get a tax credit of $2,600, which you can apply against tax, federal tax. There is no state tax credit for solar energy expenditures. So it's a great deal. That's why I think it's a great deal. I don't know why more associations don't do it. But let's take these large associations. If it's at 1,000 units, and even if the solar energy is $1 million, the amount of money that gets distributed to each owner is not that much versus the cost of letting them know and all the endless questions you're going to get about where do I put it on my tax return, how much money, anyway. So what they do instead, and also they may not have the money to go spend $1 million to put in the solar equipment. There's a third party who says to the association, I'll tell you what, we'll install the solar energy equipment at no cost to you currently. We get the solar tax credit. How do you like that? But what we do, instead of you're paying, let's say, $100,000 for the equipment, you're only going to pay $80,000 or something. You get the idea, because the third party gets the tax credit, and they'll sell you the equipment. They don't really sell it. What they do is they lease it for somewhere where they make money on the tax credit side of it too, and you get a benefit. So what's usually done is there's a 5-year lease where the association leases the solar energy equipment from the third party, and also pays a third party for consumption of electricity. At the end of the 5 years is I wouldn't call it bargain, but there's a lump sum payment where the association, it's usually much to their incentive benefit, buys the equipment from the third party, and going forward, it pays its own electricity. So remember, this is an operating expense. It's not reserves. So if the association, are you going to go purchase this equipment? It's operating. You can't take the money out of reserves to do it. Reason is it's not a component that currently exists within the association. Can't use reserve money for a component that the developer didn't put into the association when it was turned over. Okay. Now, this might be a good time to talk about, if I call it right, EV charging stations, because they're sort of related to solar. I mean, sort of. Anyway, so it's electricity. And the questions are going to come up. Well, we have a lot of owners with electric vehicles, and they're all talking about how they want to install EV charging stations in the common area and so forth. I won't talk about the rules about having it installed in common area, but I'm going to talk about the tax side of this. So the tax rules are really not as clear as they are with solar energy. It appears that it's treated in the same way, is that the association will spend, let's say, $10,000 on EV charging stations. And what they do is that even though it's used by only some of the owners, it's really was put in the common area. The association, they use their money to install it. So the association would notify the owners, I would believe in the same manner as they would with solar energy equipment, of each owner's respective share of the EV charging equipment costs, including installation. And then each owner claims it on their personal tax return. Currently, I believe the tax credit is the greater of it's the lesser of $1,000 or 26% of the qualifying expenditures. So not a lot of money, but it's still there. The association gets no benefit out of it, and there's not a lot of benefit from a tax point to the individual owners, but it's there, and something to think about when the owners are talking about wanting to put in charging stations. Okay.
So you're able to pass that
Yes.
that to the individual homeowners for their own personal.
Correct. Yeah, it doesn't qualify. It doesn't qualify for a homeowner association tax credit. It's a pass through, similar in concept to a partnership, where the expenditure is divided up among the owners, and the association notifies the owners of their share of the qualifying expenditures.
Okay, well, that's interesting. Okay, so is that the last one, or do you have another slide here?
Yeah, we got some more, because I know most of you, it's how can I say, most everyone likes to do things themselves. And I'm going to give you the wherewithal to do some of these things yourself. And you may feel much better about it rather than having to pay somebody to do it. The first one is the phone number for the Franchise Tax Board Exempt Organization Unit. And the best time to call is around 7:30 in the morning, but they're open 7:15 to 4:15. But you can imagine, like lots of places, if you call at 4 o'clock, they're probably not going to pick up the phone. Now, why would it behoove you to call them rather than ask your CPA, other than the CPA is going to charge you for doing it? Is because, believe it or not, the Franchise Tax Board Exempt Unit will do something for you because you're the association that they would never do for me. And they'll give you a second chance. They'll give you opportunities they would never give me. So it's worth it for you to give them a call. And let's just say your corporate status is suspended. You could call them and maybe they'll reinstate you if you file something right away. If I call, they're going to make me do things that you wouldn't have to do, or at least make me tell you you had to do things you wouldn't have to do otherwise. So it's a great thing for you to consider. Okay. The next second point is, I mentioned earlier, the Secretary of State. So maybe a lot of your owners are surfing the internet and they're going to the Secretary of State's website. And this is where you see the link there that you can see the corporate status of your association. If it's in good standing, suspended, or revoked. If it's suspended, go back to the previous page, call that phone number, ask the Franchise Tax Board about suspension, because what happens with the Secretary of State is that if you're late filing or don't file or don't pay or late pay, is they tell the Franchise Tax Board, who does the dirty work for them. Franchise Tax Board will suspend corporate status. So if you see that your corporate status is suspended, call the exempt unit. Ask them, how can you correct this? What can you do? The next one is, if you want to know whether your association has exemption for franchise tax or not, because this is the only way you're going to know. It used to be you had to call Franchise Tax Board, but I'll take kudos for it, that now you can find out online whether you've got exemption or not. Take a look. You can click on it, or however the link is, and you'll get your answer. Okay. The last piece of useful self-help information is, if you didn't know this, I'm telling you something you should know. Do not call the IRS. It's not because anything wrong per se. There's one, if you don't know already, there's long, very, very long waits on the phone. And secondly, when you get through, you'll find out that they're not going to talk to you because, one, you don't have the qualifications to talk with them. Could be that you're not on the board, you're not an officer, something like that. Or when you get them, you're not exactly sure how to talk to them. It's not a good idea to talk with the IRS or Franchise Tax Board about your association because you're so personally involved in it and you can't be detached. And if you rub someone the wrong way, these are the wrong people to rub the wrong way, I tell you. The better thing to do, I know it's a pain, is ask your CPA to get a power of attorney and let the CPA call. It's a special hotline for practitioners, and they get right through and they get somebody who can answer the questions right away. So that concludes my material. It's Q&A time.
Correcto. We'll go ahead. There's a couple of questions that we can get to here really quickly, and then I'll pull up the script and we can move on. So first of all, yeah, let's get to the Q&A. Hold on a second here. Robert Chatham, he's actually in the energy business, and he's our ECHO's legislative advisor. So thank you, Robert, for coming and for your questions. He's been in the energy business a long while, and he's involved with the solar passive energy as well. So it's good to have him here. So he says in your comments on solar panels on homes or common space like parking. Now,
must be common area.
You were talking.
Otherwise, it's not homeowner association property.
Yeah. And currently, Bill, I think there was a law passed in 2019, maybe 2018, where it allowed people to put their personal solar panels on common area. How do you deal with
What?
that?
Whoa, you mean that? Wow, that's a new one. I'm not sure. I'm not sure who get the tax credit there. I presume that it would be the person who's paying for the solar panels that they would get the credit, even though it's on common area. How it got there, that sounds sort of familiar. I remember hearing about that, but I
Yeah,
would think that.
I worked that bill. I worked that bill.
Oh, that was. What a
It
nightmare.
was for the equitable distribution of the common area to the various owners, because you really are
Yeah.
changing private property rights at that point. Okay, so Robert also says the same applies to storage batteries too.
If
So,
it's an EV charging station storage battery, I would presume so.
well, solar, you're
Uh,
gonna have a battery that you have to. So yeah,
Maybe
if
you
it's part
could
of the
storage.
system.
You're right. If it's part of the solar energy installation, then yeah, it's all part of that solar energy credit. Yes,
Yeah, it'd
yeah,
be good
solar
to
battery supply.
take advantage of that while you can.
Yes,
So are these tax credits on new installations only, or can they be on, I guess, old installations? I guess if you have
it have to be new. Has to
maintenance,
be new.
repair, they're
Yeah.
all okay.
It must be new equipment. Yeah.
New equipment. So if they're
New installation.
replacing old equipment, some
Yeah.
old, you don't think that?
Well, no, that double. I would double check, but I don't believe that qualifies. It must be new.
Okay, and then here's a question or an answer. The payback is 4 years. I'm not quite certain what that's related to, Robert.
I don't know.
Tell us. And he also mentions that charging is 75% cheaper than gasoline costs. So there's a
Yes, yes, it is. I mean, you've heard all about the EV movement here. That mm. So the question about can I answer the question about a fiscal year, any month?
Yep.
The answer is fiscal year. A corporation can have any year end it wants, unless the governing documents say otherwise. You can have January through December.
Mm-hmm. It's a good question to ask is what type of a business structure do you have? Is it a corporation, or what type of corporation, or is it something other than a corporation?
Yeah, but we're just homeowner associations can have any year end unless the governing documents, as that other gentleman pointed out, have a December year end. That means you ask a December year end.
Okay, so here's another question about back at the qualification of expenses and revenue types. It
Right.
says we have late fees, garage usage fees, all paid by our members. Are they tax free? Are those considered revenue?
Well, tax free. It's considered membership income.
Okay.
Form 1120. It's membership income, which is not taxable. Form 76 form the election 7604 elections made. So
Okay, but late fees are considered membership income as well
yes.
as
Oh yeah. Yes.
as well as penalties. Okay.
Yes. It's the trouble is on Form 1120H that that is non-exempt function income. So that would be taxable. That's part of the reason you consider 1120 is much more encompassing, a lot less subject to tax than 1120H.
Okay, well, good question, Mario. Helen, can you please show the last slide page again? So can you put that up? We're also going to be sending all the slides to you within the next 7 days. Connor's pretty quick at that, so you'll be getting the slides for your personal use. And if you want to share them with your boards, you can do that, or anyone else for that matter. Also, this casual community conversation is being recorded. You'll have access to that as well. Okay, and then Robert, payback, the payback for the cost of solar is 4 years. Okay, so if you're putting in the system, I guess 4 years. I think that's the last question we have.
There's a couple questions in the chat feature.
Okay.
One from James, and then there's a long question from Gerald.
Oh,
Gerald, sorry.
Can I
okay.
click on chat and then I'll see?
Yeah.
How does the HOA, this is from Gerald, how does the HOA get rebates for EV charger station rebates from state and city of Palo Alto? Do you know how that's done?
Oh, I'm not familiar with that. The ones who are installing the EVs, they should know that. I mean,
Yeah, they
but no,
should.
I'm not familiar. Sorry.
Yeah, ask the installer. That's probably the best resource, or you can probably call the city or the Palo Alto city and ask them. You can also look at the state, but that's pretty localized information. What are the EV charging station rebates, rebates?
Reserve funds? Wait, well, this is a new installation. It's all operations. It's not reserves at all.
Okay, so you could set up a savings account, if you will, in your operating budget, and if you want to
Yes.
do it over
Yeah.
time, right? I know of one HOA that contacted me. It was an older gentleman, doesn't drive, and he was going to be sent a bill for $1,000 to put in each EV charging station, and he wasn't
Oh,
happy about that. So,
wow.
so
Wow.
so
Huh?
if you're looking at putting in an EV charging station, you really need to have it vetted with the community, make sure it's okay and they understand the value to the community.
Mhm.
Uh, Okay, you did. Okay, can HOA pass assessment on to homeowners even if they do not have electric powered cars?
I think
That's a
so.
political question in your homeowner association. You could do that if the board so elects, but you really need to be very careful. As I said, I did get a call just 3 days ago from a gentleman who, he's on a fixed income. He doesn't drive. He doesn't want to pay $1,000 more for a one-time special assessment for an EV that only a handful of people in the community actually benefit from in terms of direct benefit. So be careful on that one. All
And then
right.
above Gerald, there was James' question.
Oh, okay. Regarding paying tax from reserves for reserve generated income, where should the cost of the tax preparation be paid?
That's an operating expense. That's the administrative operating. It's not tied. It's not tied into one fund, or it's not tied into the source where the money is earned. So it's administrative expense.
In administrative.
I'm sorry, operating expense. Operating expense.
Okay, so it's an operating expense.
Mhm.
Okay, so I think that kind of concludes the Q&A part of this. So we'll go ahead and do the concluding remarks here. I want to thank you, Bill, for an outstanding presentation, and thank you for the format to be able to make this casual, and so members are able to converse with you through us, of course. But we do appreciate your willingness to do this and
Of course.
here. Echo greatly appreciate your expertise and your industry leadership. So thank you for that as well. Also, thank you to a great audience. You asked some really good questions. You really were quite knowledgeable about this. So thank you for that. Please note that the Levy Erlinger Company publishes the industry leading condo green book regarding financial matters and income taxes for California HOAs. We do it we know it as the Condo Green Book. It's kind of the industry standard. You can get a copy by ordering it on ECHO's website at www.echo-ca.org, and then just click on the online store, and you'll get right to it. Or in a couple minutes, you might be a lucky winner of the day, and Connor's going to do a raffle for a few of the books. Statute book, for your benefit, ECHO has released the expanded version of the 2021 statute book and legal directory. It contains an updated Davis-Sterling Act and other statutes and case law relevant to HOAs, and a list of legal professionals specializing in HOA industry. It may be purchased on our store as well. Thank you for being a member, but if you're not a member and you attended today, ECHO holds more than 30 online educational programs per year and offers a vast array of resources for boards and HOA members. If you are not an ECHO member, please consider joining and supporting the oldest a statewide association advocating for better communities and well-informed HOA boards and homeowners. To join, simply visit our website and click on the membership tab. Thank you for coming.